Welcome to your Mortgage Insider update for December the 10th. We are one day away from the Consumer Price Index report hitting the Wall Street line on Wednesday morning. That will be 1 week before the Federal Reserve finishes their open market committee meeting, which begins next Tuesday, ends on Wednesday. This will be a pretty significant event. This is a quarterly release of the dot plot. The dot plot is where each of the Fed members actually gives out projections of what they think Fed policy will be into the future. Last time we saw that's when the September rate cut happened. That 50 basis point cut in September was also followed by the dot plot that suggested that there would likely be 100 basis points or 1% reduction in the federal funds rate by the end of this year. Well, so far we've gotten 50 basis points or 0.5% and another 25% cut just this last month. This December meeting next week will conclude the year and will be their last opportunity to finish the year out with a 1% cut in the overall federal funds rate. Now, going forward, the concern is that previously there was pretty optimistic plots from the different Fed members saying that the federal funds rate is likely going to drop down to like somewhere around 3.2% by the end of next year, 2025. So with the most recent data points after the last 90 days of inflation reports and jobs data, it's looking more like we'll start to see a little bit of a shift from the Fed. Still likely a rate cut here in December, but probably less cuts projected into the next year. So that the overall consensus is that might adjust from 3.2% by the end of next year to closer to 3.7%. So about 0.5% higher, which is basically two less 25 basis point cuts throughout the year next year. Will that come in the very first meeting of the year? We'll see. So let's take a look at the charts and see where we stand coming into the CPI report this week. For the second day this week, we see the 10-year Treasury up 4 basis points today. Started off yesterday around 4.2%, now up to 4.24% in anticipation of the upcoming CPI report. Mortgage-backed securities also falling down in their price, so interest rates are rising as the price to the investor is falling. We'll take a look at that chart too, but let's take a closer look on the 10-year. So we see the last few days we had been below the 200-day average, which was a welcome sign. Actually got below the 50-day average and tried to hold below that yesterday before coming back up, stopping, and then today extending its run a little bit higher, which could leave us open to a pretty significant move up higher before we hit the next level of 25-day moving average. That could be broken pretty significantly if we get a bad or a higher CPI inflation report, or we could start to see a mellowing out and bring us down to these averages. It's pretty widely expected to see around a 2.7% CPI headline inflation number. That's up slightly from last month at 2.6%. So basically, a miss any higher than 2.7% on inflation would likely push us higher in these rates. We could go back to levels that we ran into right before the Thanksgiving holiday, but we have had reprieve from that, and we'll hope after the CPI report, at least a calm CPI report would give us projections of calm interest rates coming into the Fed's final decision for the year. A quick look at the mortgage-backed security chart, up 11 basis points. We can see that this is the reverse action of what we saw in the 10-year. So the price to the investor, the price was rising ever since Thanksgiving as an increased price, that it decreased the overall interest rate available to consumers, which peaked here on December 6th, right before that jobs report came out, and we've really started to fall back in pricing. A lot of this just in anticipation of these big reports this week. So we will see how this plays out and come back with you next week for an update right prior to the Fed meeting.